Today I want to discuss about investment strategy, and in general I will show you a study that make in comparison three different type of strategy in the 40 years, and in general I think it will be very interesting. For who don't know about me, my name is Samuele, I'm a crypto investor, I make video about investment, cryptocurrency and so on. If you are interested in that type of content, please subscribe to the channel for not losing any video and thumbs up the video for helping me to grow YouTube. I remember you that I have a Telegram group in which we talk about new projects and news about the market, and in general I leave the link in the description. Today we will discuss about investment strategy, that is my favorite topic about investment. And in general we will answer of the question, is better to timing the markets or to doing DCA? The study that I will analyze with you is about three girls, that is Tiffany, Brittany and Sarah. The study is made on 40 years of markets, that is the same for every person, and every person save $200 a month and decide to invest in a different way. Tiffany sucks at investing, and in general in doing timing in the markets, she invests in the top of every bull market, in the worst position for buying everything. In the specific, she accumulating the $200 a month, and in general she will invest every time the market stops. The second, Brittany, doing the same, but is very good at timing the markets and buy at every bottom of the markets. The third, Sarah, decided to not care about Fed, Powell or what the markets does. She invests every month in a DCA mode. Let's talk about the results of this study. In this Excel file I will show you all the data that I find online about the study. So let's talk about the study. Like I said, there is a $200 a month and 40 years of investment that starts on 1979 to the 2020. There are the three women, Tiffany, Brittany and Sarah, and their investment and returns. For analyzing the results of the study, we go on this graph that represents on the time the portfolio of each woman, and in general we see that the worst performer is Tiffany, that is the woman that buy at the top of the markets every time, and then she has $650,000. The second is Brittany, that buy at every bottom of the market, and she returned $950,000. But the best performer is Sarah, that invests every month and she returned $1,370,000. I leave you the link in the description with the study with all the data that if you are interested to know. So when Tiffany buy, for example, in 91 of the 87, or when Brittany buy, and in general all the data that interests you. What is the conclusion of this study? In particular, we obviously know that doing DCA is better to doing a strategy based on timing the market, because as much time we stay in the markets, as much results we supposed to have. DCA is confirmed the best way to invest in the markets for every asset. I think in general is the best for index. DCA is the best way to invest in the market from my point of view, and this study confirms that. Of course, for the long term. Let me know in the comment what do you think about that. Please thumbs up the video for helping the channel and subscribe to the channel for not losing any video. We will see you in the next video.